all start. I'll do an intro, introduce everybody. You're the last person I introduce. Right, ladies and gentlemen, good morning. Good morning. Welcome to this somewhat more intimate stage, Da Vinci stage. As you can see, a smaller area, more intimate area, and maybe even an area where we get into more into grips with some of these insights, ideas, perspectives as well. So I'm intrigued as much as you are really to hear and see how things are going to kind of unfold right here on the Da Vinci stage. We kick off with our very first session right now, all about rethinking tokenomics with milestone-based vesting, all jumping right into this, really kind of unpacking really what it's all about, but also more importantly, helping you make sense of really where we are, but more importantly, those questions, helping you make better decisions as well. Again, I'm intrigued as much as you are really to hear how this is going to unfold right now. Let's now invite to the stage our panelists and our moderator to kind of share with us right now really what it's all about. Please welcome to the stage right now Mohamed Ezeldin, Keli Callaghan, Nicholas Pelecanos, Katryna Hanush, and our moderator who's going to beautifully shape this moving forward. We also have Youngsun Shin. Youngsun, going to sit here. You take
Good morning, bonjour. So welcome to Proof of Talk, and we're gonna have a pretty chill session, free-flowing, good discussions with some experts in the industry for 40 minutes. And also, I think because obviously there's a smaller crowd versus the main stage, the benefit of that is you guys being able to be more engaging with us and having a chance to maybe ask questions at the end. So we'll kind of direct most of the questions at the end of the session. So if you guys have any questions during any of your chats or any of our wonderful speakers' comments, please keep it in mind. So we'll have plenty of time for you to actually directly engage with our speakers here. So now I think our session says rethinking tokenomics with milestone-based vesting. I want to first go ahead and introduce our speakers, and then kind of start off with a refresher on where the market is at, in the status quo. So why don't we start with you, Mo? I mean, just briefly introduce who you are, what you do.
Hello, everyone. Great to be here today. I'm Mohamed Ezeldin. I'm the head of Tokenomics at Animoca Brands. At Animoca Brands, we're really an ecosystem builder where we have an investment arm. We have different advisory arms as well, including token advisory, marketing, market making. A lot of the work that I do is helping founders with their 0 to 1, where we see 1 being TGE. The focus really is on how can we design a solid foundation for a token economy that can grow and iterate over time. So I'll leave it at that, and then we can dive more into what that actually means throughout the panel. Thank you very much.
All right, and Keli?
Keli Callaghan, I'm a partner at Arrington Capital. I've been in the space full-time for 8 years. Prior to joining Arrington, I was the CMO at Algorand and worked very closely with Silvio Micali. So my background is very based on go-to-market, brand, building a community. Was really proud of the community we built at Algorand in the early days. And now, as a partner at Arrington, I work with a lot of our early-stage founders in what they do to go to market, to engage their community, to create strong programs and incentives for their people.
Yeah, hi everyone. My name is Nicholas Pelecanos. First off, thank you all for coming in. I know that whatever's on that main stage must be very exciting. So to have you all here, we feel very humbled. I've been in the space also for 8 years. Initially, I was working with some top 10 protocols on treasury management. I've helped build and scale some of the largest treasuries in the industry. And the cycle after that, I was in the founding team of the #1 launchpad in the industry. While I was there, I was behind some of the most performant launches of the last cycle. In the bear market, I started Trireme. Trireme is effectively a market maker. I'd say we're potentially the fastest growing. We just turned 2 weeks ago. We service over 100 clients. We have staff across the globe, and that's us, yeah.
Hello, everyone. My name is Katryna. I represent Wintermute on the BD and partnership side. I have been in the space for over 4 years, and prior to that, I spent 15 years in traditional finance, sales and trading, fixed income, currencies and commodities. In my line of work, we work with some of the largest foundations and treasuries. We partnered with 150 top as a market maker, but we have 3 business lines. One is market making on CeFi and DeFi, where we have arguably the largest market share across some of the biggest pools. 2, supporting token launches, and that's where Tokenomics review comes into place. And then also third one is the OTC distribution to some of the largest institutional retail venues, retail apps, and again, working with the treasuries to build some solid foundations, helps them with blocks in both liquid and vested tokens.
All right, I think wonderful panel. So before we begin, I think I want to just kind of start off with a small question to the crowd. I know there's not a huge people, so it's probably not statistically representative. But who here has ever invested in a crypto token that had a vesting schedule attached to it? Raise your hand. Oh. That's quite a bit of people here. So I think that is where we start as a lot of crypto tokens, if you actually buy it, if you invest it, there's sometimes a lot of vesting schedules or vesting schemes attached to it versus when you buy it on let's say OTC or on SEXs where there's no vestings attached to it. So that's where I think the session kind of starts. And secondly, I think this is more directed to our speakers as my first question. And just to let you guys know, we haven't had a pre-set questions that I've prepped together as a document. So this is going to be actually a raw material coming from the industry experts.
Doing it live, I like it.
It's the live session. So, well, why do we have to rethink tokenomics? I think that would be my first question. I think maybe we can start with Katryna. Why do you think we have to rethink the current tokenomics? What's the issue here? Or is there an issue?
I think it's a loaded question, right? So, I have probably a personal perspective having invested and also, I'm kind of representing the company. So from a personal perspective, I think a lot of my friends are now seeing the trend where, well, if I know it's a good project, it's so much easier to just buy the liquid tokens because then you don't have the vesting, right? From a VC perspective, generally classical, you look at the forward curve in TradFi. Here, very similarly, we look at, regardless of the vesting, even if it's a classical 1+2, 1+3, you're looking at 30% erosion of the price, right? So that's how you price it in. The same from a market making perspective. When on the trading side, we look at the vesting, we see sometimes huge discounts being traded. And you can't blame their VCs, right? They want to exit the liquidity. But I think from a treasury perspective, from a foundation perspective, from a project perspective, many of them don't know how to structure tokenomics correctly, and that's what it comes down to, right? We speak to founders where they think TGE, as Mo said, from 0 to 1, TGE is day 1 of the work starting, right? It's still a very young company. Quite often they're just a startup. And I think quite often they don't even think about tokenomics, or maybe they just don't have enough advisory or input how to structure it correctly. So everyone goes for the classic. And I think something worth mentioning before I pass on the microphone is that a lot of the times, especially when we deal with tier 1 foundations, quite often there are also regulatory and compliance restrictions why vesting is structured that way. There is a term of so-called lawyer token, right, where many of them have to have a 1-year lockup just because not to be considered an unregistered securities under the SEC in US and being distributed to the most protected demographic in the world. So I think there's a lot that is being discussed right now, and I will pass on so people can give their input as well.
Yeah, I think it's a good perspective on how teams aren't necessarily really structuring it well, right? I want to mix it a little bit, ask Nick a second question. Versus, let's say, other types of traditional vestings on, let's say, stock or other assets. Do you think inherently or structurally crypto needs a different vesting program? Or do you think it's just a matter of execution, like what Katryna said is more of a major problem here?
Yeah, look, it really is a mix. So obviously a stock has value, and so if you have value, you can price the asset at a fair price. With tokens, they don't have value, and they're simply a consequence of supply and demand, right? Supply and demand are the raw inputs to price. So when you have a vesting schedule, effectively you're inflating the supply of a project, right? And unless you have equal or greater demand coming into that project, the price is going to go in one way, right? Now, obviously, you can model out token utilities and token flywheels so that the ecosystem itself starts to grow and it has buybacks and, you know, hopefully price starts to trend in a certain direction. But unfortunately, very few projects actually reach the critical mass required for that flywheel to kick in and for us to actually see the impact on the price and the value of the token, right? So it's very important to always be thinking about, okay, who is the user, right? The majority of users are traders, right? Or there's a small portion of people who might actually use the utility. And what is the demand that they're going to bring? And how do I match my supply relative to that demand to make sure that the asset continues to perform? Because unfortunately, you know, and this market in particular, it's a very prominent issue. Once you lose bid and interest in an altcoin, effectively the price and volume goes to zero, just simply because of the amount of supply of projects coming to market. So yeah, look, it's extremely important that we think about how to work these token models, but ultimately we're still in a young stage of the evolution of the industry where it's simply liquidity driven. And if the demand isn't there, the asset's not going to perform.
Got it. I mean, now we have like two people who are kind of on some of the customer side of these projects as well, like being investors or like capital. What's your view on, let's say, projects pitching to VCs on that they can, let's say, go to market fast, list fast, and then you'll end up, you know, let's say, making a back. But from a capital perspective, what do you think the balance should lie?
So I'm going to say, caveat, we have a liquid trading side of our fund and we have a private venture side of our fund. I am not a trader, so I'm bringing an alternative take here. We are founders first, so we're looking at the founder, what they're doing for the ecosystem, what products they're bringing to market, what the utility of is, how strong that is. So I think that's a fundamental. So when we're looking at anything, we invest in people all the time that don't have a fully baked tokenomics plan. And you are taking a bet on what they're building and the team that's behind it. And so I think the token economics are a part of it, but not in full when you're looking and evaluating something. Now that being said, obviously you're looking at the time of a cycle that we're in. We're obviously paying attention to regulatory environment across certain regions and geos. And so all of those things come into play. I will say that there's an element of how open projects are to engaging and listening to their communities. I think it's really important, especially I've been there, I've been on that other side, and I know how important it is to constantly drive utility, to create that balancing act of having something that's, you know, utility-based and might be complex, but having it simple enough that people can participate and grok their heads around that stuff and do it. So I think there's a balancing act, there's a number of things that come into play, and I think all of those are important here.
Yeah, because I think in the early 2024, there was a huge trend of like a high FTV, low float strategy where, you know, tokens were launching really quickly at a high FTV, gave investors a buck, and then the vestings were like unlock X% at the beginning of TG with the sex listing, and then just linear time-based unlock, which still benefited a lot of investors. Some of tokens have, you know, given me some profit, but I knew that they weren't really healthy, right? But I still profited off from them. So I think there's a mixed feeling from an investor perspective, which I want to get to with Mo, because, you know, Animoca incubates a lot of projects. And how do you guys advise, or what's your thought or philosophy around the tokenomics as is now?
I mean, for us, we're an ecosystem builder first. We do have a venture arm, which is, again, the purpose of any venture arm is to make money. When we invest from balance sheet, it's less so on the money-making side and more so on supporting the ecosystem. Now, one of the biggest challenges that we see in the industry are the different personas we have. A lot of the angel investors or VCs in the space are looking for a quick buck, which is why you tend to get unlocks at TGE. They're able to get they're able to raise in the beginning, but also they know that they can lock in some of those profits or make a bag. I think the other side of it is growth is non-linear, and this is something we were having a chat just before we came on stage. Yet we look at the growth of a token ecosystem or a token economy in a linear sense, and instantly there's a mismarriage between both. And I feel that's one of the challenges that exists. Another challenge is that the majority of retail in the space are actually extractors. They're not looking or coming into a project for the utility or to add value. It's actually, how can I grind for an airdrop, receive that value? Back to your point, when it was high FDV, low float, you'd quickly see how those prices would crash, because it becomes a race to who can cash out first and get the most bang for their buck. So we've already identified two quick challenges there, or two major challenges. I think for founders, quick show of hands, how many of us are founders in the room? Okay, so not many. How many of us are investors as well? Okay, not a lot as well. How many of us are here just out of interest? Okay, fair enough. So if you are a founder, and I was touch on a point Katryna said, a lot of founders think TGE is the end. It's not. TGE is the beginning. As soon as your token is live, and my wife hates it when I use this analogy, TGE is akin to childbirth. When a child is born, you do not leave your child unattended. You're checking if it's breathing in the night. Does it need to be fed? Does it need to be changed? It's exactly the same thing with your token economy. The other aspect is, when you're designing your token economy, what you're really designing is a foundation that you can build and iterate from. It's not the case that, oh, in the white paper we said X, Y, and Z, so we have to stick diligently to X, Y, and Z for the next 3, 4, 5, 6 years. There needs to be iterations, there needs to be upgrades to make sure that we're actually representing different stakeholders' interest in the right way. What does that look like when it comes to vesting? I think it's probably something we can dive into later on.
Yeah, I mean, I think, you put it spot on. I think because we kind of discussed a little bit about like what the problem is, the current status quo. I actually want to really give you guys a big challenge by we're gonna it's a fun time to discuss a little bit of what could be, right? And I know that there's a definite upside in these tokens having a better liquidity for investors or VCs, because that's one of the reasons why that these money is moving towards the crypto space, because they can actually cycle their money faster, which I think is still a benefit that we want to keep, right? But at the same time, we also want to make sure that these are not rugging you straight on, and make sure that these projects are held accountable. The question is, how do we do that? And I want to start with Nick this time. What do you think is something that needs to happen? For example, do you have any structure in mind that would work well?
Yeah, so I think to elaborate on your point there, it's important to understand the participants in the market, right? So when a token launches, effectively you have the project team, you have its investors, right? Whether they're VCs or public sale, and then you have market makers, and then you have exchanges, right? So if you look at the commercial terms with these different parties, you'll see that generally the tokens involved, right? If you're an investor, you're exchanging dollars for tokens. If you're in the team, you're exchanging your hard labor hours for tokens. If you're an exchange, you're getting paid marketing fees in tokens, right? And if you're a market maker, you're getting given tokens to provide liquidity. Now, if you sum all of that token supply coming to the market at once, you'll get a number, you'll get a figure, and that could be 100,000 or it could be 10 million based on the size of the project. Now, unless you have equal or greater demand coming into the launch of that project, the price is going to go in one direction, right? So again, it's just simply supply and demand, and then the price will go down, right? So how do you manage these different stakeholders? Well, if we start again with the investors, right? The proposition of invest your money into this asset and then be locked based on a bunch of KPIs and milestones that the project needs to hit before you get your money back is a pretty bad one, right? Again, to your point, investors are excited about investing in crypto projects because they get a quick flip. They can sell their tokens early on. So again, if you're an investor, what do you want to do? Well, you want to get your money out as quick as possible. If you're the team, generally they have longer vests. Unfortunately, the team will have their ecosystem allocation or marketing, and I can tell you firsthand that often the team is selling out of those allocations as well. But ultimately, the team has OPEX, they have operational expenditures that they need to meet, so they sell the token anyway, right? So that they can meet the operational expenditures after they've burnt through their funding, right? And then again, you have your retail, you have your exchanges, they always sell. And then you have your market makers, and then depending on the deal terms with the market makers, you might have a lot of selling pressure, you might have a little selling pressure, but ultimately, who's buying it and how are they buying it? And if you're managing your treasury well, you should be structuring it as such that you will be able to step in like a central bank would in times of uncertainty and support price. And also when things are overheating, they should be able to step in and cool things down to build that war chest, to deploy back into the market. And again, that comes down to good treasury management, but also through market making.
I think, Keli, you had some comments to say.
Like a lot of selling going on in your examples, but which I think happens. But I also think for projects that have really strong product market fit and are sharing that with all of those stakeholders, investors, maybe not market makers and exchanges, right? Like that's a different ballgame, but investors, community, people that have taken a stake, projects that are building on you, partnerships you have within the network. If you're bringing those people along on your vision and they believe in what you're doing, you're not, like, we will invest in projects. We've got token allocations, they're locked up, they're great. We will go and buy more tokens on the open market if we believe in the power of what those founders are doing and we believe in the vision that they're working on. So I think there's an element here of also, not all projects are good at that. Not all projects are really strong at bringing people along, whether that's explaining what they're doing, bringing them on the journey, and making them wealthy along the way. Like, as long as you're hitting, like you said, it's the birth of it. That's just the beginning. That's not the end, like I'm out. And so, which is why you have founder vesting schedules that are quite lengthy, and that's the way that the world works, right? But that's just part of it. TGE is just the beginning. And so to bring these people along on the journey, I think is really important and not to be missed. And I think it needs to be part of the token conversation, because if you're not doing that and you're not creating, whether it's milestones that you're holding yourself accountable, milestones that are transparent, and maybe I think the governance element of it gets a little bit funky. I know there's foundations that have, struggled, and some have been better with grant program, but it's a whole separate thing to manage. And so I think you just need to take all those things into consideration.
Yeah, Mo, I think I want to discuss a little bit about things that we, talked in Lisbon. What are some of the potential possible milestone-based tokenomics that would actually work for everyone? Like, what are some of the things that Animoca is advising to projects to implement?
I mean, there isn't a one-size-fits-all approach, because when we touched on high FTV, low float, you can have the other end of the spectrum where it's at 100% float at TGE, and then there's no soul pressure coming in. So then it really depends on where the project is at. I think just before answering that, maybe just to give a bit more context, when we look at a token is a product within itself. When you look at a founder of a project, they're also a product. And the reason I say that is a lot of the attention that comes to a token ecosystem doesn't come to the token itself, unless maybe you're a Bitcoin or an Ethereum or an established token. If you're a newer token, it's all about the narrative. Crypto is an attention economy, and we tend to see that attention translate into price action, which I think is a point Nick was making earlier on as well. So all of a sudden, you have your product which needs to find PMF. You have your token, which is a product that needs a product suite, which includes different kinds of staking. And then you have the founder or the founders who are products within their own right, helping raise awareness. And then when you look at all of these things and sort of coming back to approaches we're taking and bringing it back to the title, we know linear-based vesting in general doesn't work. A milestone-based vesting, they know what are the milestones we're looking at. Is it gross on the platform side or the product side? Or are the metrics we're looking at more on the volume? A lot of time, if you're launching on a bigger exchange, aka a Binance or maybe a Coinbase or an OKX or an Upbit, you can expect that initial volume coming in and there to be a lot of trading volume, which actually means for market makers that there's an opportunity for you to be liquidating some tokens of minimal impact on price. So when we start thinking about what does dynamic vesting look like, well, it can be based on maybe on-chain metrics or volume-based metrics, so we're able to start unlocking maybe some of the investors earlier because there's less detriment to the price. I think what we tend to see, retail has wisened up. No one wants to be dumped on, especially if there's in some instances, there's an unlock every 3 months in some projects, and you end up getting 2, 3, 4, 5% of the supply unlocking at once. That's a big red flag. So what will people do? Retail will start dumping the tokens prior to the unlock, knowing investors are unlocking. They'll wait for the token to dip, and then they'll buy back. And only in tokens where there's conviction, I think, to what the point Keli was making, that then investors can come and buy back. So we know that doesn't work, or there's limited success. So it's more the case of how can we be unlocking tokens dynamically based on the market conditions. And sentiment within the market is super important, because what we've seen with the longer vesting schedules, at least over the last couple of cycles, are that the good investor who maybe believes in the ecosystem building, who doesn't want tokens unlocked at TGE because they know that's detrimental to the growth of the treasury of a project, are actually being burnt, because by the time they begin unlocking, it's a bear market. And what does that mean? The token's down 97%. So I feel like we do need to protect investors, but at the same time, you have to protect the community, which leads me to my final point on this, is really the majority of the user base or the community are extractors, are speculators. Now, you need speculators to help drive liquidity, but when the majority of your user base are speculators, that's an issue within itself, because you don't have people buying the token to leverage it. If it's for governance, if there's a utility there, or maybe it's an outright DeFi token and there's some kind of yield that's coming in, we don't see people buying the tokens for their intended use case. They're more buying it because there's a short-term ROI, and that's a problem that we have, which is why PMF is so important, just to bring in that user base.
Katryna, I think you had a smile briefly during Mo's chat, but I actually put you last because I wanted to get to the point where, the linear unlocks have like a vesting schedule where everyone just knows, right? Everyone knows that moment's coming. So there's news that spreads, there's a big sui unlock at this date. So everyone getting ready to whether there's going to be a down pressure or like build up to the up pressure made by some of the drivers in the market, versus what I think Mo's proposing, or some of the milestone-based, vesting. Aren't there like any other risk attached to it? Because there might be actually like a more sell-off, no?
Yes, I agree. So the reason I smiled is because, both milestone and the kind of timeline, they can be not manipulated, but there is something that is going in the background, right? Like I smiled when you said extractive, because I think it's just the problem is we have a lot of kind of professional farmers, right? It's kind of an industrial grade operation for many. You still have local community, maybe 22K on Twitter is your target, but the PMF is very, very important. And for us, the main consideration is that the team has longer vesting than investors. That should always be the number one. The way that I'm seeing now lots of interesting proposals that are people discussing is called adoption-adjusted vesting. So adoption-adjusted would be something to do with the price. So going back to what we were discussing about the flow, because right now you list a token, 10% is PMF, 90% is the flow, buyers, sellers, roughly, right? And the idea is that either people launch too fast, too early, or they launch and there's no product. No one is using the product, right? Why is Hyperliquid so successful? Because everyone is using the product. You need to start with the product. How do you launch a global product in multiple countries and multiple jurisdictions and multiple languages where people use the actual product? So outside of that, where we see founders who also want to just get that, right? Like quite often behind the scenes, the conversations is going, is my VC front running me, or the founder can do a TPA in the secondary market and get that, right? Like quite often they sell the dream to the market makers, they sell the dream to the investors, they sell the dream to the exchanges, and then run away, right? So outside of the real kind of concern that probably no one wants to talk about, the manipulation that happens in the markets, and we see that, some of the tier ones with a high float, this is all optics. Quite often the airdrops are being distributed to, friends and family wallets. So if we're talking about doing it ethically and compliantly, then the only way to do that is to do how you would do it in the TradFi. The corporate, treasuries, I covered a lot of them, they would say, okay, this is my price and this is my target, right? And at that price, I will be selling in the market, and at that price, I will be buying back, right? So they have hopefully some revenue, because hopefully if they have revenues, they can do those buybacks, right? And we are seeing more and more of that. So that's the way I would do it, is I would look almost like outside of, the milestones and the timeline is there a way where you can build a price corridor, and at some point, if you have real healthy revenue and a PMF and a real users, could you be buying back to control the supply and demand? And this is what I'm seeing more and more from very, very professional names. The second part I would do is also, I would say, well, I'm as a treasury, because, all of the VCs want to get out, right? And all of them are trying to think who has the biggest credit rating, who can take the biggest, can be given the biggest credit line by market makers or in the secondary. Is there ways that the treasury manager can say, well, no, we will do that. We will do that and we will distribute it, right? If you're going to be thinking about the execution, and sometimes it's very, very difficult to execute that. Sometimes, for instance, we as a market maker, we would say, okay, don't sell more than 5% of the daily volume. That's not healthy, because even with 10% and above, you're sending selling signal. No matter how good is your execution, how minimized your market impact is, everyone will see, because everything is transparent. That's number 2. And number 3, again, having those corridors and kind of doing it in the centralized ways and distributing. And I agree with Keli. We're also seeing VCs who maybe didn't get in, and they come in and say, we want to buy in the market because we believe in the team. So I don't think it's as value extractive. It's just there's a lot of combination of things where some of it is optics and some of it like real value-driven, fundamentally driven, right? And the last thing I wanted to say, some of the people complain about the lack of liquidity. Some of the penny stocks also have lack of liquidity. Why? Because they're penny stocks, right? They were never meant to be tier 1. So maybe not all projects in crypto are also meant to be tier 1 and have tier 1 liquidity, tier 1 venue, tier 1 market makers. They just never really achieved the milestones that are required. So kind of those are my 3 points.
Got it. Yeah, I mean, I have a last question for everyone, and then we'll kind of open up the stage for some of the questions related to milestone investing. I'm going to start with Keli first, because I think Katryna talked a little bit about adoption-adjusted vesting and the demand and supply of the market. As a founder first, would you advise, this is my question, would you advise founders to actually push the TGE to happen a little bit later after the product launches, as if we would do in TradFi? And this is my pre-question, and then the actual question is, what would be a prime milestone that you would put, if you could, at a milestone vesting? This is for everyone to have it in your minds before I get to you.
Yeah, I think, listen, we've been playing this game. First of all, I have these conversations with our founders quite a bit, and TGE moves frequently, and lots of times it gets pushed out because we want to get this one more thing wrapped up in our smart contract, which makes total sense. I think there's an element of timing the market and the cycle, and there's an element of being ready and buttoned up for it. I think the other thing is, in crypto, we've always announced announcements, and and we're playing this game of, to a certain extreme, people don't even know what's real versus what's coming. I lose sight sometimes. We have 350 private venture investments. We're a small team, and it's a lot of different moving pieces to take care of. I'm hands-on, and I like working with everyone. I lose sight of, wait, is that something that's coming in 6 months? I thought you said that was here already, right? And so I think, back to the narrative conversation, I think we need to pull some of that in, and it needs to be realistic. Yes, I would absolutely tell someone to put off by a month, 2 months, 3 months, so that they could get somewhere that had a working product. And I think they need to have, it's not just similar to TGE is just the start. It's not just, oh, okay, this one last thing and then do TGE. It's more, what's coming the following month? What's 60 days later? What's the 3-month plan, the 6-month plan? Give me the whole thing on how you're going to keep engagement going, how you're going to continue to add utility, how you're going to continue to let people become a part of it and earn from it and become wealthy with it along with the growth of the project. So I think there's a few things that come into play, but those are sort of the top things that come to mind.
Got it. So if you had to pick one, what would it be for a milestone?
One milestone before you do TGE?
No, one milestone as a prime cursor for vesting.
Oh, as a prime cursor for vesting. I love you have to reach a certain adoption metric. Yeah, for sure. It's not Twitter followers. It's not how many people you have in your Discord. It's not any of these, goalposts that we keep moving up. It's not any of that stuff you can buy with bots. It is actual adoption, and that means different things depending on what industry you're playing in. I mean, travel's here. It might be hotel rooms booked, right? That's very different than a TVL and a smart contract that has a yield paying on a daily basis or something like that.
Got it. Nick, what's your take? What would be your, prime, milestone that you would choose if you had to choose one that applies to the crypto token vesting?
Yeah, I think ultimately it's going to be price and volume, right? Because, as I said several times, it ultimately comes back to supply and demand. So if you don't have the demand there and you inflate the supply, it trades in one direction. So yeah, I guess Katryna's point's bang on in that sense. The issue is like 90% of the IDOs this cycle are trading below IDO price, right? So I think there's a balance that you need to strike between what is the investable opportunity here, otherwise you can't get it off the ground, and what's realistic for us to achieve. And me and Mo were chatting earlier about this. Ultimately, it comes down to, okay, we can have milestones, but there needs to be a time-based element. But just if you think about timing as well, you can build a really great product, and you can spend a lot of time doing it, but if you launch in the wrong conditions, and the asset doesn't trade well, then the market will lose interest immediately just because the market's very PvP right now. It just chases narrative. So I think it's a mix, but ultimately I think the points I've made already are quite valid.
Would you extend on that, Katryna? Like, would you just resonate on it, or would you have any other points on the milestone that you would choose?
I do. I always have an opinion. So I think with milestone, again, it's very sometimes easy to manipulate if it's not algorithmically coded, right? And I think it's quite wrong sometimes that people just kind of so focused on decentralization, because as Mo said, growth is never linear. So you sometimes, like even when you look at the airdrops, quite often it's kind of giving you an indication what the team considers valuable historically, but also giving you an indication of what the forward airdrop would look like, right? How do you incentivize your community long term? So I think the main important part is that the milestones are clear and transparent. They're algorithmically pre-coded, i.e. there's no DAOs, there's no nepotism, there's no kind of founders telling people what to do. It's kind of algorithmically predefined, but not too far in advance, because how can we sitting here today, can even say where the market is going to be in 1 year, 2 years, 3 years, 4 years' time? It's so unpredictable. So I think it's very important for them to be able to adjust it, looking at what they consider next milestone to be. It doesn't have to be defined. Maybe more you have a different opinion and you can kind of, predefine 4 years in advance, but I feel like it's just so unpredictable. Market conditions are so important, right? And again, if the market conditions have the volume, have the interest, have the hype, have the narrative, sell some more. If there is not enough, then go in the building stage and just don't sell anything, right? That's the way I would look at it.
I think sometimes it's nice to zoom out when we're looking at things, and a lot of founders are building products fundamentally for Web 2, but they're trying to find PMF in Web 3. And I think that's one of the biggest challenges we're seeing. We've already established a user base in Web 3, more often than not are after ROI, that they're after liquidity, they're after increasing their bags, if you like. So when we look at products that have found PMF in Web 3, it's always revolved around price or around information. So around trading, around information, which is why Hyperliquid found PMF first, and then we saw the increase in price because there's an actual use case for the token. You can argue with Cato as well. Quick show of hands, how many of us have heard of Hyperliquid? Okay, how many of us have heard of Cato? Okay, a few of us, not many. So Cato fundamentally, it's your hub, or the meta right now is InfoFi, so information finance, and Cato brings together your on-chain information plus your social information or data as well, and it's a good tool to use to understand what's trending, what's not just from a price action perspective, but also from a social perspective. That's one approach, and we know that works. The other approach is actually, if the market conditions are ripe and you have attention, and attention is key here, you can actually launch a token pre-product, because what you're doing is leveraging that token to increase your user base, but also having a treasury that you can start spending from to increase the value proposition, to grow a product as well. So there are two approaches. I mean, the preferred approach is finding PMF, but coming back to the, it was what do you call it? Something adjusted vesting.
Well, you can choose your
adoption.
Yeah.
Adoption. So I think the adoption adjusted vesting, coming back, if a product is in Web 3, but it's meant to be aimed at Web 2, then an adoption adjusted vesting may not work, because it's the wrong user that's adopting the product. So I feel at that point, it's then around the liquidity and the volume that's there. I feel if it's a product in Web 2 and the user base that's coming in Web 2, then I'm calling it AAV for ease, makes a lot more sense at that point, because you know the adoption of the product, you know the lifetime value of that customer, and you know the revenue that's being generated from that perspective.
Agree. One thing to add, I think adoption adjusted can also be the price that has been reached, right? So that would be also reflective of the market. And one thing probably for the milestones, I think what would be important is kind of having revenue, because we see that long-term successful project is going back to Web 2. If they have revenue, you have some cushioned treasury, you can run for many months. You don't have to worry about selling too quickly.
Got it.
100%.
I mean, yeah, it's interesting examples, and I think there is no currently a set silver bullet answer, because like you said, Hyperliquid is a good example of finding a PMF and then going TG. But at the same time, if you look at their volume, a lot of their volume has grown significantly after TG, because that has definitely played a part in actually getting the adoption up. So I think it's like a chicken and an egg problem where we need to all figure it out for the next cycle. But now that said, we have some room for questions to open up for the audience. I'm sure a lot of people, when you guys first raised your hand, had experience investment that had vesting on crypto. So if you guys have any questions to the speakers, specific speakers, or general panel, please raise your hand, and our wonderful MC would get to you and help you.
What do you guys think are some best practices in slashing unnecessary token inflation?
So the question is the best practices in fighting unnecessary token inflation. Is that correct?
Yeah, slashing them.
Slashing?
Slashing unnecessary token inflation.
Yeah, I think if you look at a token vesting schedule, generally you've got investor allocations, team allocations, then you've got marketing, ecosystem, stuff like that. A lot of the time, those allocations just aren't used, and they're easy to target to slash. And a lot of projects that say they're doing burns or cutting supply are actually taking down that allocation. So they're the easy ones to go for. If you really want to show commitment, extending team vests and investor vests is always a good sign as well.
Any other questions? Just put up your hand. We've got about 2 minutes left.
If you're thinking something, there's a good chance other people are thinking it in the room, so don't be afraid to ask the question.
You're curious. You'd like to challenge maybe some of what you've heard here on stage as well. Hands up.
We have a hand at the back.
Thank you. Very, very insightful panel. Thank you all very much. I have missed the beginning, so I'm sorry. My question about the milestone-based vesting is, has it been tried, or is there a legal basis for it to actually be tried at a project? Because a big reason why projects have time-based vesting are legal agreements that have been set up years before.
I think it's a very good question. And for example, you guys mentioned a lot about adoption-based vesting and a lot of the ideas that are thrown around. Some of them might never meet, and from an investor protection perspective, you'll never really. Also, there's a set goals that you need to reach. What's your take, Mo?
I think a lot of tokens historically have launched through a foundation, and part of that reason and part of the vesting that comes into that is just to make sure that they're compliant. I think what we saw with Trump launching his coin prior to coming in as president without a foundation structure, without any kind of structure, to be honest, sort of opened up Pandora's box, if you like. So I feel that there is a change in the wind and the narrative around token launches, and that's having an impact on projects that are launching. We're seeing so many more projects launching meme coins, which will then become utility coins, so they can go for 100% float on day one. Maybe more so on the culture side. So how many of us have heard of Pudgy Penguins or Rizuki? Quick show of hands. Okay, quite a few of us. They launched their tokens as meme coins, for that specific reason, so they don't fall foul of the regulation side of things. So we're starting to see different types of launches, but regulation always lags behind innovation. So until there's a clearer framework in terms of what that looks like, we'll always be in this limbo of, are we going the old route, which is a foundation route, or are we going to take maybe a more exotic route and launch as a meme coin that then discovers all of these utilities moving forward? So there's no promises to stakeholders.
All right, that was Rethinking Tokenomics with milestone-based vestings. We had Mo from Animoca, Keli from Arrington Capital, Nick from Trireme Trading, Katryna from Wintermute. please give a round of applause for our panel. And feel free to reach out to them after the stage for any questions or engagement. I mean, that's why we're all here. So thanks, everyone, for listening in.
Thank you so much. Fantastic. And again, remember, everybody that you see here on stage, that you hear here on stage, again, you're curious, you'd like to know more, you'd like to challenge maybe some of the people here on stage as well. They'll be here, I'm sure, today, again, tomorrow as well. Have a coffee, have a chat, and take those conversations